Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. And here's your host, Paul Winkler.
Welcome. This is the Investor Coaching Show. Paul Winkler, talking about money and investing. Educating, because that's what we do around here. Now, I was looking through the Wall Street Journal and looking through an app on my phone. I thought, you know what? I'm going to do this little thing on just the news. What if you open up your phone? As an investor, you're trying to figure out what to do. Is it a good time to get in the market? Is it a bad time to get in the market? Is it a good time to just stay on the sidelines because things look kind of crazy out there? Or is it a good time? I got cash. I'm trying to think, do I stick that in the market? Do I not stick that in the market? Do I, kind of wait until I get a little bit more clearer sign? And, that's a hard decision to try to grapple with. And it makes it even harder if you read the news and you start to understand a little bit what makes it so hard. It's kind of interesting, actually. So I just thought I'd just scroll through my phone for a second and just look a little bit about what's being written out here. Okay, so let's see. Fed poise interest rates, shrink portfolio. We talked about interest rates and the Fed quite a lot lately. I'll skip that one. EU proposing ban on oil imports, sending prices higher. Okay, yeah, so we got an expense issue coming along. How about something about the economy? Okay, so you have the ex-Fed chairwoman, Janet Yellen, saying that U.S. economy remains strong. Okay, so you got that. That's a good little positive thing right there. This one. The pandemic normal is here, and it isn't that special. So there's more. This one says that it's there's more behind the stock market's downdraft than higher inflation and interest rates. It's also a sign that the economy has arrived at a new post-pandemic normal, and it isn't as lucrative as investors had hoped. Okay, so investors want companies to be more profitable, and this change has made things a little bit more rough to get to that lucrative state where we're making more profits. And let's see, what else does it say? Pandemic catalyzed a once-in-a-generation change in consumer, worker, and company behavior, a shift to a more remote life and work accompanied by digitization of business models. Well, with this, it hits me here as I'm reading this going, well, if you think about it, it's a new normal, and they're saying that it has affected the stock market. They're downdraft in the stock market as they start off, and then they talk about that, and they say, well, which market? Well, if you think about it, the area of the markets that have been hit the hardest are the ones that most American investors tend to be most focused in, which is large U.S. stocks. Now, why would companies be large? Maybe because the model that they used was the most lucrative in the past, right? So what would have been the most lucrative in the past? Going to the consumer through retail outlets, stores, getting out and about, shopping. Maybe that the new normal is going to create new markets in other areas. Think smaller companies. You need to be more invested in smaller companies. Simply because historically the returns are higher. That there is one of the reasons that I tell people that we tend to be a lot smaller than, if you look at the big mutual fund companies. I just did a workshop on this where I was actually taking the biggest companies out there in Fidelity and Vanguard and taking their models of their portfolios and looking at the average market cap of their funds that they manage, their target funds or their life strategy funds in the case of Vanguard, and Fidelity, their asset manager models that they have. And I just looked at, okay, what's the average size of the companies in there? And it was way, way bigger than I would have. Way bigger. And you look at that and go, well, if there's a new normal out there and we're trying to adapt to it, who is going to be better at adapting to that? Companies that are up and coming. And the reason being is because, older, more stodgy companies, they can't make the move as fast. And it's challenging for them because they're already big for them to get even bigger. So I look at that and go, well, you know what? As it really, if you look at this, you say, okay, so a company that has already been there, done that, and is an old technology wouldn't necessarily change. Now, Amazon became very, very big. Why? Because they capitalized on this idea that people weren't necessarily going to go shopping directly at the places, then they couldn't get out anymore because everybody was kind of hiding from each other. But, people are learning to live with this, and this is kind of the change that we're seeing right here. And an investor reading this article would come to a conclusion. Well, the companies aren't going to be as profitable in the future, so it's going to be problematic. Now, who says they're not going to be as profitable? They're only looking at one metric in this article, which is sales. Now, they're missing the fact that what companies are going to do is they're going to reduce expenses, right? So if you were saying, hey, the new normal is my income isn't going to rise as fast as I thought it was going to be. Well, maybe I don't buy as big of a house. Maybe I don't buy as nice of a car. Maybe I don't go and go on as many exotic vacations. I back off on my expenditures. Why? Because I want to make sure that I make it in whatever the new normal is for me. Same thing with a company. So to come to the conclusion that this is bad is kind of silly because companies will adapt. And it's even if they're not selling the products necessarily, they're going to benefit from the new normal. They're going to do something or whatever they've got to do to get back to profitability and get back to where things are growing again. And the other thing about the stock market is, think companies have to pay to use your money. Is it riskier when you've got a new normal that you've got to adapt to? And I would submit, yes, it is. It's riskier. So as an investor, what are you going to do? You're going to pay a price that is commensurate with the amount of risk that you're actually taking on so that your returns, that you're handsomely rewarded for whatever risk you're taking. So to basically give the impression that returns will be lower in the future is actually not terribly accurate. So let's see, what else is in here? How about this one? American consumers are shopping, traveling, and working out like it's 2019. Okay, so this is pre-pandemic, right? So 2019. And this article is giving you totally the opposite impression on how things are going to go. Isn't that funny? People have returned to their old habits in many ways. This is the subtitle. In many ways, while pandemic stars like hand sanitizer and stationary bikes have faded. Remember when everybody's like falling head over heels, they're buying Peloton. I remember, Peloton. I remember walking into, when I could finally go back to a store like a Target or a Walmart or something like that. I remember trying to get, free weights, like dumbbells or something like that, because you couldn't get into the gym anymore. And I remember they didn't have any. They were all sold out. Well, I guess that went. That came and went, right? That problem. Now it says Americans in early 2020, many companies said the pandemic would change everything for consumers, and it did for a while. But people were acting like this is the way it was going to be forever. Remember the stock market dropping like a rock? And what we did here on the show is I brought everybody in, Evan, Ira, and Jonathan, and Arlene, and Ann, and Jim, and we all came together, every one of us, and we just did these shows here together, talking about how people, you guys can get a little bit over the top regarding the sales, and this was back in March of 2020. And you're getting really panicky over this thing, acting like this is going to be the way life is forever. And you forget this kind of stuff comes and goes. And of course, it did come and go. Now, it says now many Americans are resuming their pre-pandemic habits, rocking out at crowded concerts, doing deadlifts next to strangers at the gym. Yeah, see, that whole thing, that happens to be in this article, as a matter of fact, talking about the gym and how people are going back. and stocking a standard supply of toilet paper. I mean, good grief. Just remember that? You'd be walking through a grocery store and the person in front of you is, loaded up their cart full of stuff. I had one client that was telling me, he goes, I can tell you what happened with toilet paper. And I was like, okay, great. And it was just fascinating learning what actually caused the shortages. And, it was, I remember, you know what it was? It was interesting because he said a lot of the products that we use, the paper products, he said, were made from recycled paper. And I said, yeah. And he goes, well, think about it. Where'd they get recycled paper? And I said, where? And he said, offices. And I said, oh my goodness, that's fascinating. Never thought about it. Offices were closed, so therefore companies didn't have paper products that they were using to the degree that they normally did. And then as a result of it, what ended up happening, they didn't have paper to recycle. I guess that's kind of related to where people were, you look downtown at these huge cities and they had rats everywhere. And I was like, well, where on earth they all come from? Well, they were normally well fed from restaurants and the restaurants were closed down. I guess that's somehow related. But yes, over 2 million people traveled by plane each day on an average between April 17th, 23rd, according to Transportation TSA, Transportation Security Administration. And a lot of these companies, Netflix and Peloton, all these companies that were doing so great, not necessarily so much. Instacart, they slashed their valuation according to this article. And so you would come to a completely different conclusion if you read this article, wouldn't you? You'd come to the conclusion that, okay, well, you know what? Everything's great. Everything's coming back again. The prior one, it was, no, it's here and it's not that special. It's terrible. And what else is in? This is interesting. I mean, we look at Germany and we look at, some of the troubles that they're running into over there because of, Europe, Russia, Ukraine. Well, VW wants to step up investment in U.S. manufacturing. Now, who does that benefit? It benefits the U.S., but it also benefits a German company that looks at the U.S. and goes, hey, you know what? Let's see what it says here. It says Volkswagen said it's accelerating its push into key U.S. auto markets where it expects little impact on growth from a Ukraine war or China's COVID-19 lockdowns. Yeah, look at you. There you go. There's another one right there. China. Locking down and putting fences around apartment complexes so that people can't get out. I'm speechless when it comes to that kind of stuff. But here's the thing. Right there, that's a whole topic in that a company will do what they've got to do to get back to profitability. Even if they're thrown a bunch of lemons, they're going to make lemonade out of it. And that's exactly what is going on with VW right there. If you look at that, they're going, okay, well, you know what? Europe is a little bit of a tizzy, an issue. We got some problems, supply chain problems, food problems, energy problems, where we don't necessarily have that in the U.S. And we can go and pull our operations out and we can set up shop in some other country where this stuff isn't happening. And that benefits a company that would be in your international portfolio, most likely. So you look at that and go, wow, there's a great example of a company adapting to circumstances. And, it's just looking through the headlines, and I'll stop there. But looking through the headlines, you can see why an investor would come to the conclusion that, it's a really good time to invest. Yeah, you see that whole thing with the post-pandemic, and if the picture you saw that's actually goes with it is a bunch of people partying, younger people, they're excited, they're having a big time, they're having a blast. And you go, wow, maybe it's, happy days are here again, as the old song goes, right? Or you may not have seen that article, and you saw the other one saying, oh, things are just quite as good as we thought they were going to be. And you may come to the conclusion, hey, we're in for a long haul, not a good time to invest. And hence, whatever your mindset is, typically what happens, and we call it confirmation bias. And there's actually a name for this psychological bias that we have as humans. We come to the conclusion, do I want to invest? If I want to invest and I want to be convinced it's a good time to invest, I will probably miss all of the negative articles on how things are so bad right now. If I don't want to invest, and then what I'll do is I'll see all the positive ones and I'll jump in. If I don't want to invest or I want to be convinced that maybe it's not a good time, maybe that side of me is really speaking, then I would look for all the articles that say, hey, things aren't so great right now. May want to hang on, may want to wait. Things aren't so good. And we will look for information that confirms our bias, what we want to hear. And then we will act accordingly. It's the human condition. We're a tough breed to figure out because we are so driven by things that just we're not even conscious of. It's the way it works.